Okay, so you want to buy a luxury car brand. Find a factory, hire some engineers, put a raging bull or a prancing horse on the hood, and watch the billionaires come running. Except here's what nobody tells you up front. The most profitable luxury car company on the planet deliberately manufactures fewer cars than it could sell, has a multi-year waiting list for its most popular models, and has turned away more customers than it has accepted, not because of supply chain problems or chip shortages, but as a calculated business strategy. Scarcity is not a problem Ferrari is trying to solve. Scarcity is the product. By the end of this video, you'll know what it actually costs to own a luxury car brand, why selling more cars can destroy the business faster than selling none, and why the most famous sports car company in history is valued more like a handbag brand than an automaker. Let's start with the price tag. Luxury car brands come in 3 tiers. And they are 3 completely different businesses. The entry level is a niche manufacturer, something like Lotus, Pagani, or Koenigsegg. Annual production of a few hundred cars, revenue under $500 million. These companies change hands for $100 to $300 million. You get a famous name, a small factory, an engineering team, and a brand that enthusiasts love, and the general public has mostly never heard of. The middle tier is where most of the famous names live: Lamborghini, Bentley, Maserati, Aston Martin. These brands sell anywhere from 5,000 to 30,000 cars a year. Revenue runs $2 to $5 billion. Acquisition cost ranges from $500 million to $3 billion. Tata Motors paid Ford $2.3 billion for Jaguar Land Rover in 2008. VW paid roughly $430 million for Bentley in 1998. That deal now looks like the greatest automotive acquisition in history. Bentley's annual revenue today is over $3 billion. And then there's the top tier: Ferrari, Rolls-Royce, Porsche. Not the whole VW group, just Porsche the brand. These are not car companies with luxury ambitions. They are luxury empires that happen to make cars. Ferrari listed on the New York Stock Exchange in 2015. Its current market cap sits above $55 billion. That makes Ferrari worth more than Ford and General Motors combined. Ford sells 4 million cars a year. Ferrari sells 13,600. Do the math on what the market thinks each Ferrari is worth compared to each Ford. Now here's the cost nobody puts in the brochure. The first is the platform. Every luxury car sits on an engineering foundation called a platform. The chassis, the architecture, the structural DNA of the vehicle. Developing a new platform from scratch costs $1 to $2 billion. Lamborghini's Huracan and Urus share platforms with Audi and Porsche because developing their own would bankrupt the brand twice over. Ferrari is the exception. They develop proprietary platforms in-house. That's a large part of why Ferrari costs $55 billion to own, and Lamborghini needed Volkswagen's balance sheet to survive. The second cost is regulation. The European Union has mandated that every car manufacturer sell only zero-emission vehicles by 2035. For a brand like Lamborghini, whose identity is built entirely around a naturally aspirated V12 engine making sounds that would make a grown man cry in a parking garage. This is an existential problem. Electrifying a luxury car brand costs $5 to $10 billion. Not in a single payment, in a decade-long restructuring that touches every part of the business, every engineering decision, every supplier relationship. Porsche has spent approximately $7 billion on its electrification program, and Porsche is the most financially healthy performance car brand on the planet. The third cost is homologation, the process of certifying a vehicle for sale in each individual market. A single crash test program costs $50 million. Certifying a new model for the United States, Europe, China, and the Middle East simultaneously can cost $200 million before a single customer takes delivery. Now here's where it gets interesting. Where does the money actually come from? The naive answer is, you sell expensive cars, you make expensive profits. Ferrari charges $250,000 for an entry model. Rolls-Royce starts at $330,000. A Bugatti Chiron lists at $3.3 million. Enormous prices, enormous margins. Except the production cars are not where luxury brands make their real money. The first revenue engine is limited editions. Ferrari releases special series vehicles, extremely limited production runs with prices that make the standard lineup look affordable. The LaFerrari was produced in 499 units, priced at $1.4 million each, and was sold out before a single car was built. The Ferrari SP3 Daytona, 599 units, $2.2 million each, same story, sold before it was shown publicly. And here's the part most people miss. To be eligible to purchase one of these cars, you don't just need the money. You need a purchase history. Ferrari tracks every car you have ever bought from them. A first-time buyer cannot acquire a limited edition Ferrari, full stop. You have to earn the right to spend $2 million on a car. That is the exclusivity economy in its purest form. The second revenue engine is merchandise and licensing. The Ferrari store generates hundreds of millions annually from clothing, accessories, watches, and branded experiences. Ferrari has theme parks in Spain, Abu Dhabi, and Portugal. Ferrari licenses its name to a clothing line, a watch partnership, and lifestyle products that have nothing to do with cars. The brand is the product. The cars are the proof that the brand deserves to exist. The third and largest hidden revenue engine is financial services. BMW Financial Services generated 36 billion euros in revenue in 2023, more than most car companies earn from selling actual vehicles. Every time a customer finances a Porsche, leases a Bentley, or insures a Rolls-Royce through a captive finance arm owned by the parent group, that interest income flows directly to the manufacturer. The car is the product. The loan is the business. Step back for a second. The central paradox of this industry is brutal. Every instinct in business tells you to sell more, scale up, hit more customers, grow revenue. But in luxury cars, the moment you follow that instinct, you begin destroying the asset you're trying to monetize. Maserati spent the 2010s aggressively expanding production, chasing volume, adding SUVs, dropping prices. Revenue went up. Brand perception collapsed. Maserati went from a symbol of Italian exclusivity to something you see in rental fleets outside airports in Dubai. Stellantis is now spending billions trying to reverse that damage. Jaguar Land Rover made the same mistake. Expanded too fast. Sold too many cars. The Land Rover badge started appearing in school car parks across suburban England. The luxury premium evaporated. Tata spent the better part of a decade and multiple billions trying to rebuild the positioning. Ferrari watched both and did the opposite. When the market was growing, Ferrari raised prices and held production flat. When customers begged for an SUV, Ferrari refused for 2 decades. Because the CEO believed a Ferrari SUV would signal to the market that Ferrari needed the money, which would tell the market that a Ferrari was not that special after all. When Ferrari finally released the Puro Sangue in 2022, their first 4-door model, they announced they would permanently cap its production at 20% of total output. Not because they couldn't sell more, because they wouldn't. That restraint is worth approximately $55 billion on the New York Stock Exchange. Now for the failures. Because there are many. Aston Martin has gone bankrupt 7 times. Not 7 close calls, 7 formal insolvencies. The brand makes extraordinary cars. The business has never figured out how to make money making them. Current market cap sits around $1.3 billion. The brand name alone should be worth more than that. But a brand without a business model is a name on a building, and Aston Martin has been that building for most of its history. Bugatti is more instructive. Volkswagen acquired Bugatti in 1998 and spent the next 25 years building what is arguably the most extreme production car ever made. The Veyron and then the Chiron, sold at $1.5 million and $3.3 million respectively. By most estimates, Volkswagen lost money on every single Bugatti it produced. The Veyron reportedly cost more to build than its sale price. VW sold 70% of Bugatti to a Rimac-led consortium in 2021 at a valuation that suggested the entire enterprise was worth less than what the company had spent developing a single model. Bugatti exists not as a profit center, but as a proof of concept. The brand pays for itself in reputational currency. That only works if you're Volkswagen. DeLorean is the cleanest failure of all. One iconic car, one iconic movie, one factory in Northern Ireland, $175 million in British government subsidies, and a cocaine trafficking arrest of the founder that became one of the most famous FBI sting operations in American history. Bankrupt. 1982. The cars are now worth $50,000 each. The company made nothing. Here is the dynamic nobody explains when you start looking at this industry. Luxury car brands are not car companies. They are identity companies that use engineering as their proof of credibility. A customer buying a Ferrari is not buying transportation. They are buying membership in a specific social class. The car is the certificate. This is exactly why Ferrari's biggest competitors are not Lamborghini and McLaren. They are Patek Philippe watches, Hermes handbags, and private jet memberships. Every one of those purchases is saying the same thing in a different format, which means the skills required to run a luxury car company successfully are not engineering skills. They are brand skills. The greatest luxury car executives in history were not great engineers. They were great editors. They understood what to say no to. And in luxury, saying no is the entire job. Time to pull it all together. 3 scenarios. Real numbers. Scenario 1. A small niche manufacturer for $200 million. Annual revenue around $300 million. Operating costs in the same range. Net profit close to zero, often a small loss. You own one of the most famous names in automotive history and spend every year trying to keep the lights on. The only real exit is selling to someone with a bigger balance sheet. This is Lotus. This is the old Aston Martin. Prestige without profitability. Scenario 2. A mid-tier brand at real scale. Bentley level, $2 to $4 billion in annual revenue, operating margin of 5 to 10% in a good year, net profit of $100 to $400 million. But you need to be inside a larger group, a VW, a BMW, a Stellantis, because electrification costs alone would overwhelm a standalone brand. The business works, but only as part of something bigger. Scenario 3. Ferrari. $6 billion in revenue, $1.5 billion in net profit, 25% operating margin, 13,000 cars a year, a waiting list measured in years. A merchandise and licensing business growing faster than the car division, market cap of $55 billion and rising. Ferrari is not valued as a car company. It is valued as a luxury goods conglomerate that has never made a bad handbag because it doesn't make handbags. Every car is the handbag. Every customer is a collector. Every limited edition is a piece of art with 4 wheels and 700 horsepower. The barrier to reaching that level is also extraordinary. You cannot build Ferrari from scratch. You can only inherit it, acquire it, or spend 50 years building something adjacent and hope the market eventually treats you the same way. So, if you do decide to buy a luxury car brand, remember the most important rule of this business. The moment you need the revenue, the brand stops being luxury. And the moment the brand stops being luxury, you have a very expensive factory and nothing else. The product is desire. Manage the desire. The cars will follow.